There's a specific kind of silence that descends on Wall Street on a Friday evening. Usually it's the silence of relief. The trading week is over, the terminals go dark, the bankers head to their Hamptons houses to drink champagne and pretend they understand risk management. But this weekend, the silence is different. It's the silence of a bomb squad staring at a wire they just failed to cut. We just witnessed something that was not supposed to happen. According to the script that has run for 40 years, according to the playbook that has crushed silver bulls decade after decade, silver was supposed to crash on Friday. They tried to smash it at 65. They tried to pin it below 66. They fired every weapon in their arsenal. But the market didn't just hold, it accelerated. The closing price on every screen around the world shows $67. Let that number burn into your memory. 67.14. We didn't just break resistance. We didn't just squeeze through a technical level. We blew the roof off the building. We closed at the absolute highs of the week, on a Friday, during the exact time window when silver has been ritually murdered for 4 decades. For retail investors checking their portfolios, this is a moment of celebration. But inside the risk management departments of the major bullion banks, this is a nightmare scenario beyond their worst projections. Because markets are closed. They are trapped. They are holding billions of dollars in short positions that are now deeply underwater. And they have to sit there for 48 hours unable to trade, unable to hedge, unable to stop the bleeding. The panic is building behind closed doors, and when those doors open on Monday morning, the stampede begins. This is the story of the weekend the banks lost control, the weekend the physical market officially divorced the paper market, the weekend when 4 decades of price suppression died in real time. To understand the magnitude of 67.14, you have to understand what traders call the Friday script. For decades, silver investors have suffered from a predictable torture routine. We would have a great week. The price would rally Tuesday through Thursday. Everyone would get excited. Retail buyers would start paying attention. The momentum would build. And then, at exactly 10:00 a.m. New York time on Friday, like clockwork, wham, a massive sell order would hit the futures market. 2, 3, sometimes 5,000 contracts dumped in seconds. The price would crater $2 or $3 in minutes. We would close the week demoralized and weak. It was surgical. It was designed to ruin your weekend. It was designed to make you feel like a fool for believing the rally was real. It was designed to program you to sell on Friday morning before they could dump on you again. This psychological conditioning ran so deep that professional traders called it Friday fatigue. They would exit their long positions on Thursday just to avoid the pain. The banks had trained an entire generation of silver investors to be their own worst enemy. We saw them try it again this week. Right on schedule, the selling came. We saw the attempt to pin the price below $65. The algorithms fired. The sell orders cascaded. Fear. Not fear of a crash, fear of not owning enough. The buyers were so desperate to get positioned that they didn't care about price. They weren't trying to buy the dip. They weren't waiting for a pullback. They were paying any price necessary to be holding silver over the weekend. They know what's coming next week. And they didn't want to be left behind when it arrives. Now put yourself in the shoes of a commercial short seller. You're a bank. You sold silver short at $64, promising to deliver metal later at that price. You expected the Friday script to work. You expected the price to drop so you could buy back your position at $60 and pocket the difference. But the price is $67.14. You're losing more than $3 per ounce on millions of ounces, and the market is closed. You are in prison. You cannot exit your trade. You cannot adjust your position. You cannot do anything except watch the news all weekend and sweat. You have to watch the geopolitical tensions escalate. You have to watch the articles about Samsung's silver-hungry batteries go viral. You have to watch the reports about solar panel shortages spread across social media. And every piece of news that breaks makes your situation worse, because you know that when the Asian markets open on Sunday night, everyone else will be reading that same news. If Asia gaps the price to $68 or $69, your losses expand exponentially. This creates a psychological pressure cooker. The risk managers at the major banks are currently running stress tests, asking the terrifying question, what happens if silver opens at $70 on Monday? Can we survive that scenario? If the answer is no, then they have only one choice. They have to issue what's called a market on open buy order. They have to tell their traders, I don't care what the price is on Sunday night. Buy it all. Close the position. Stop the bleeding. This is how you get what traders call a gap and go. The pent-up panic from the weekend releases all at once in the first minute of trading. We are set up for one of the most violent opens in precious metals history. But the paper market panic is only half the story. While the banks are trapped with their short positions over the weekend, something even more dangerous is happening in the physical world. The dealers are freezing. The supply chain is seizing up. The disconnect between paper prices and physical reality is becoming impossible to hide. Right now, this very moment, if you try to buy physical silver at anywhere near the spot price of 67 to 14, you'll discover something shocking. You can't. The dealers have either gone dark, jacked their premiums to $75 or $80, or simply put out of stock banners on everything. This isn't a coincidence. This isn't temporary holiday inventory issues. This is systematic supply chain paralysis driven by what industry insiders call replacement cost terror. Imagine you're a bullion dealer. On Friday morning, when silver was trading at $63, you sold 1,000 ounces to customers for $64 each. You took their cash. You promised to ship the coins. Standard business practice is to call your wholesaler on Monday morning and replace that inventory for maybe $63.50, making a small profit on the spread. But now the price is $67.14 and climbing. The premiums are expanding. To replace those 1,000 ounces you just sold, you might have to pay $70 or $75 per ounce. You just lost $6 to $11 per ounce on the entire transaction. You sold gold to buy paper, and the paper lost value over a weekend. This is called replacement cost risk, and it's absolutely lethal in a violent bull market. If you're a dealer and you sell your inventory when prices are moving this fast, you can go bankrupt. But when the price hits $67 and holds, when rumors of shortages start flying, when the physical premiums explode, the wealthy clients get nervous. They start asking uncomfortable questions. Does the bank actually have my silver? Can you prove it? This weekend, family offices are quietly sending instructions to convert their unallocated holdings to allocated. Put my name on specific bars. Move them to segregated storage. Send me the serial numbers. I want proof of ownership. This forces the banks to show their hands. If they actually have the silver sitting in their vaults, fine. They can move it to allocated storage. But if they don't, if they've leased it out to Samsung or sold it to Chinese battery manufacturers, they have a massive problem. They have to go into the market immediately and buy replacement metal to satisfy their clients. They cannot tell a billionaire, sorry, we don't actually have your silver. That triggers lawsuits and a collapse of confidence. So they quietly pay whatever it takes to get the bars. They pay $68. They pay $70. They pay $75, whatever the market demands. This internal squeeze is invisible to retail traders, but it's the driving force behind the resilience we saw on Friday. The banks aren't just fighting against outside speculators. They're bidding against each other to secure metal they owe to their own clients. They're trapped in a web of their own fractional reserve lending. While the Western banking system panics, something else is happening that makes the situation exponentially worse. The Shanghai magnet is pulling every loose ounce of silver out of Western vaults and shipping it east. The arbitrage spread between New York and Shanghai has exploded to $5 per ounce. The COMEX closed at $67.14, but silver in China is trading at $72 due to the industrial panic we've documented. Solar manufacturers desperate for material, battery companies hoarding for 2026 production, government stockpiling for strategic reserves. A $5 arbitrage spread in commodities is like a black hole. It has infinite gravitational pull. Every refiner, every wholesaler, every entity with physical metal looks at those two prices and makes the obvious decision. They ship everything to China. This creates a supply shock in the West that compounds every weekend as Asian markets trade while Western markets sleep. The metal that normally replenishes COMEX vaults gets diverted. The inventory that usually sits in London gets withdrawn and shipped east. The Shanghai magnet is systematically draining the liquidity out of the Western financial system. And because Western markets are closed over the weekend, while Asian markets continue trading, the spread widens even further. While New York sleeps, the metal leaves. When New York wakes up Monday morning, the cupboards will be measurably more bare than they were on Friday. There's another drain on supply that never shows up on any public inventory reports: direct procurement. In a normal market, companies like Samsung or Tesla might buy silver futures to hedge their input costs. But in a shortage market, futures contracts are useless. You can't build a battery with a paper contract. You need actual metal in your factory. So what are these industrial giants doing this weekend while the exchanges are closed? They're making off-market deals. They're calling mining companies directly. We'll buy your entire production for the next 2 years. We'll pay you $70 per ounce, and we'll pick it up at the mine gate. This is catastrophic for the COMEX. The exchange relies on excess silver from miners flowing into its vaults to back the paper contracts. But if Tesla buys silver before it even leaves the ground, that metal never reaches the COMEX. It disappears from the public ledger entirely. We're seeing a bifurcation of the silver market. There's the public market, where crumbs are traded back and forth by speculators and hedge funds. And there's the private market, where massive tonnages are being locked up by strategic industries for multi-year periods. The public market thinks there's plenty of silver available. The private market knows there's almost none left. This weekend, while public markets sleep, the private market is busy securing the last remaining stockpiles. This leads us to a controversial truth that's becoming impossible to ignore. The spot price is broken. For 40 years, we've accepted that the price discovered on the futures exchanges was the real price of silver. That mechanism worked because you could easily convert paper contracts into physical metal. But that assumption is failing. The registered category in COMEX vaults tells the real story. This is the metal that's legally available to settle futures contracts. For years, this number has been dropping from 150 million ounces to 80 million to 30 million. With the price at $67 and rising, we're entering the danger zone for a delivery default. The shorts who are trapped have two choices: pay billions in cash to close their positions, or deliver physical metal. They would love to deliver the metal. It's cheaper than buying back contracts at these losses, but they don't have the metal. They can't get it from London because Shanghai is buying it all. They can't get it from miners because Samsung bought future production. So they're forced to raid the COMEX registered inventory. We're watching the eligible category, private storage, stay relatively flat while the registered category, public inventory available for delivery, evaporates. If registered inventory hits zero or gets close enough to cause panic, the exchange breaks. They have to declare force majeure and settle in cash only. This weekend, traders are doing the math on the cover ratio. How many paper claims exist for every physical ounce available for delivery? That ratio is exploding higher. The higher the price goes, the more people demand physical delivery. The more people demand delivery, the faster the registered vaults drain. The faster the vaults drain, the higher the price goes to ration the remaining supply. It's a feedback loop that ends with the destruction of the paper market's credibility. So what happens when the bell rings on Sunday night at 6 p.m. Eastern? We have hedge funds facing margin calls they can't meet. We have dealers desperate to restock inventory they can't find. We have banks scrambling to cover unallocated deficits they can't fill. And on the other side, nobody wants to sell. Who's going to sell silver at 67 cents when it looks like it is heading to 100? The miners aren't selling. They're holding production, waiting for higher prices. The stackers aren't selling. This imbalance between massive forced buying and zero willing selling creates gaps. The price teleports. It might close Friday at 67.14 and open Sunday at 69.50. It skips all the prices in between. This is the nightmare scenario for the shorts. They don't even get a chance to cover their positions at $68. They get filled at $70 and their losses expand instantly. If we see a gap up on Sunday night, it confirms that the weekend margin calls were real. It confirms that the panic is systemic. And it sets the stage for a run to 75 by Wednesday as the buying pressure cascades through the system. But whether we gap up on Monday or pull back to test support, the verdict of this weekly closing candle is undeniable. We closed at the highs, we absorbed massive selling pressure, we broke the 40-year suppression script. The trend has changed from down to up. The psychology has changed from fear to greed. The flow of metal has changed from west to east. The relationship between paper and physical has changed from correlation to complete disconnect. The banks are having a nightmare weekend. Risk managers are running stress tests. Prime brokers are calculating margin calls. Physical dealers are hiding inventory. Wealthy clients are demanding allocated storage. The physical supply isn't just tight anymore. For all practical purposes, it's gone. Locked up by industry, shipped to Asia, hidden by dealers, hoarded by the smart money. And the price? The price you see on the screen is becoming a fiction, a reference point for a paper market that's losing its connection to physical reality. 67.14 isn't the destination, it's just a milestone. The first major crack in a price suppression system that held for 4 decades. Once that system breaks completely, once the physical market fully divorces from paper, we're going to discover what silver is actually worth when industrial necessity meets geological scarcity. The nightmare scenario for the banks is the dream scenario for anyone holding physical metal. The weekend of silence is ending. The stampede begins Monday morning. The physical supply is gone. The dealers have frozen sales. The banks are trapped. This is where the story gets darker. What we're witnessing isn't just a supply shortage. It's the systematic breakdown of the pricing mechanism itself. Most people think the silver market is simple. Miners dig metal, dealers buy it, customers buy it. Supply and demand sets the price. The reality is far more fragile. The modern silver market is built on paper promises, fractional reserves, and unallocated claims. Here's what's really happening. Most silver being traded isn't silver at all. It's IOUs, digital entries. When you buy from dealers, you're often buying a claim against their inventory pool. That pool is run like a fractional reserve bank, maybe 20% physical metal, 80% paper claims. When the price explodes to 67.14 on Friday, when shortage rumors spread, everyone wants their metal simultaneously. The dealer looks at their vault and realizes they have 1,000 ounces of physical metal, but 5,000 ounces of customer claims. This is why they freeze, why websites go into maintenance mode. They're buying time to source the metal they owe without bankrupting themselves. We're hearing reports about emergency meetings, panicked calls to suppliers, desperate attempts to find inventory. Some dealers are calling pawn shops, collectors, even jewelry stores. But here's the critical point. Once you sell physical silver back into this broken system, you might never get it back at any reasonable price. The smart money isn't selling, they're holding, they're waiting. The mathematics are undeniable. If dealers struggle with 1,000-ounce lots, imagine Samsung needing 10 million ounces for batteries. Imagine government's strategic stockpiling. $67.14 isn't just a technical breakout. It's where the shortage became impossible to hide. Below $60, dealers could source metal with difficulty. At $67, sourcing became sporadic. Above $70, it might become impossible. We're looking at a cascade where each supply chain level breaks in sequence. Retail dealers freeze. Wholesale distributors stop orders. Refiners halt production. Miners hold back, waiting for higher prices. At each level, shortage worsens. Price gaps bigger. Panic accelerates. The banking system has no answer because you cannot print silver. You cannot regulate it into existence. If the metal is locked in supply chains, hidden in vaults shipped to Asia, no amount of paper manipulation brings it back. $67.14 represents a point of no return. Paper silver and physical silver are becoming different markets entirely. The spot price is becoming a historical curiosity. The real price is whatever desperate buyers pay for actual metal. Right now, that's much higher than screens show. Dealers know it, banks know it, industrial buyers know it. Reality has a way of asserting itself. When the physical shortage becomes undeniable, when price disconnection becomes impossible to ignore, the stampede into physical silver will make everything so far look like a warm-up. The physical supply is gone. The dealers have frozen sales. The banks are trapped. The weekend of silence is ending. Monday morning, the stampede begins, and we're just getting started.